welcome to NewFinance, our Insurance Disruptors session. I'm one of your hosts. I'm Eddie George. I'm the founder and CEO of NewFinance. Mark Pearce, my other host.
Yeah, hello everyone. My name's Mark Pearce. I'm head of analytics at a company called Iris. We're a technology company and we're an intermediary between, a conduit between intermediaries in the market, i.e. IFAs, and also insurance companies. We did a pilot for this back in November, and that was really fascinating. There was a guy called Kim Miller from JFloat who presented his business case, and I think that's going to come to fruition soon. I've been chatting to people in the audience today, and some of the models that are out there are just absolutely fascinating, and hopefully today we'll learn a lot more about it. If you want to know more about Iris, just grab hold of me later on.
This is part of our Insurance Disruptors series. So as Mark says, in November we kind of put our toe in the water. This is a 6-month series to bring everyone together. 5 months where we look at technologies that disrupt insurance. We're going to have a hackathon in July. And most of you probably realise, insurance is relatively, banking has moved ahead quite a lot in terms of innovation. Insurance is just kind of getting started. So we're not showcasing so much. We're really looking at to sort of create ideas around innovation. Today's agenda, quick intro from myself and Mark. We have Guy from Bought by Many, who's ready to go here. Ralph, you're here somewhere? There you are. Ralph Hazel from Insure My Friend. We're going to have a couple of breakout sessions. We'll give you some scenarios to work on, some breaks between those, then we'll have a reflection learning session at the end. Very quickly, about crowd insurance. The peer-to-peer side on the banking side in NewFinance is quite large. There's about 180 companies or 200 companies in the UK. So on the peer-to-peer lending side, crowd investing, crowd giving, crowd everything else, that's all rather mature. It's relatively new on the insurance side, and two business models are emerging, and we have them both very nicely represented here by Guy and Ralph. One of them is around crowd, which is where people get together to buy stuff and get a bulk discount and use the power of their crowd. And the other one is where they effectively create their own syndicate, which is Ralph's side of things, where they get together to insure each other, almost like a return to mutualism, but in a digital way. So those two models are emerging, and happily we have demos from two companies roughly in that space. I know it's not an exact break, but it's kind of roughly what's happening. And we have two scenarios around those two business models and how they disrupt insurance. So moving on, Guy, would you like to switch us over to your presentation? So we have Guy Farley from Bought by Many.
Morning everyone. As Eddie said, I'm Guy Farley from Bought by Many. I'm the CTO and co-founder of Bought by Many. We started the company, we launched the website in September of 2012, so we're just over 18 months old, and I'll give you a little talk through what we do and why we think it's working. So let me give you the two-sentence pitch. So at Bought by Many, we connect people together that have similar insurance needs into groups, and then we use the fact that there's some bulk buying capability in that group to get them a better deal on insurance. And that better deal could mean something as simple as a discount, or it could mean that there's some additional cover that's specific to that particular need, or it could be that that need is very difficult to get in the marketplace at all as an individual. And we've got groups in all three of those categories. We've focused most of our resources in the last few months on pet insurance, simply because of the size we are, and we thought we would go after one particular sector, crack that, and then move out. But we have done some homes, some personal accidents cover, some travel. There's about 160, 170 groups now. And as you can see from this, it's 16,500 members, 178 groups exactly. There we go. So from the consumer side, it's fairly obvious what we're up to. We're just improving their deal on insurance. And then from the insurer side, insurers are generally happy to work with us for three reasons. One is that our cost of acquisition, because we use social channels and we ask people to invite their friends into the groups, our cost of acquisition is lower. So there's a bit left in the cost of acquisition that the insurer would normally pay for us to rebate to the customer. So the discount generally doesn't affect the margin the insurer is making. Secondly, we can target narrow niches like a particular breed of dog or a thatched house or someone on a floodplain or whatever it is that particular need is more effectively than the large insurers can. They're very good at the above-the-line marketing spend, brand type awareness, not so great at targeting people down at the specific risk need or specific risk level. And then finally, we can also help the insurers to target places where they think that particular risk is profitable. So they think they've got some sort of underwriting advantage, and they can either make a profit on that risk, or it's an area that they're underexposed to, and therefore there's some capital sort of adequacy requirements by releasing, by rebalancing the book. So we think it works from both sides, from the consumer side and from the insurer side. And as Eddie said, we're not P2P. And the reason we're not P2P, and I don't want to put anybody off, but we thought that for us as a startup was too big a leap for the consumer to get. If we wanted to get people who would buy a normal motor policy or a normal home policy into a slightly different model, we wanted to make it just a slightly different model, not a massively different model at this stage. And it doesn't mean that I think P2P won't work. I think it makes perfect sense from an economic perspective, and I'm sure it will be a model that people become aware of and understand, but we felt that was too big a journey for us as a startup to take people on. So I'm just going to run through a typical journey of a person through our site. So we do a lot of posts on Facebook, and so here's one. I noticed there's an office pug here actually, which we started with pugs, but for some reason I've got the Staffy example. So this is a typical post of ours, and this is get yourself a 20% discount on your insurance for Staffy owners. And really what I wanted to show you here is the sort of level of engagement. So this particular ad post has been liked by, 788 people, I guess, like that. It's had 41 shares. And you can see the conversation that's gone on, in this post about Staffies. Now, there's obviously a nice sort of crossover between people's pets and Facebook, and they like to talk about their pets on Facebook, so that works as a medium in this case. But the great thing about this is, all the traffic beyond the original post is not generated by us in any way. So that's all sort of free publicity, if you like, and hopefully subsequent traffic into our site. And then I guess the other thing, I'll just show you one more. This is travel insurance for people with Crohn's disease, another post. And what's interesting about this one is, and I can maybe show you, but there isn't really time to go into it, but there's a huge amount of information in here for us about the problems or not that Crohn's disease people have getting travel insurance. And as it turns out from reading this post, it's actually not as hard as we first thought. A lot of the insurers just cover it anyway. But that's really interesting feedback as well. So a typical journey for one of our folk would be, I'll do the Crohn's one. They click on one of these and they see one of our landing pages. Now, this is not great at this size, but if I can, I'm not very good with PCs, so if this goes wrong. Okay. This page is designed for mobile, not for the desktop, so if I just do this. So this is what the landing page they would see. So they get some social proof up here saying all these people are in the group and would you like to join, and the little join button stays with them all the way through the scroll, and as they go down here they kind of get some why you should do it, and who's bought by many, and if you don't want to buy, tell us when you would like to buy, and we must be credible because all these people have written about us, and these are our great testimonials. So that's a sort of typical landing page, and you would join the group from here. So I would say about 90% of our users authenticate with Facebook, and that's largely because we drive the traffic from Facebook at the moment, not because they particularly choose Facebook as their authentication mechanism, if you like. The nice thing about that is, and you haven't seen it, because I'm already a member of Bought by Many and I've already been through the app authentication stage previously, you didn't see the permissions bit, but they give us permission to see their public profile, see their friends, see their likes, and see their groups at the point they log in. And we look at that information and keep hold of that information. And you can't see it here because of this particular journey, but we allow people, we're split testing at the moment between sharing this. So you've joined the group, and the very first thing we say to you is tell somebody else. So, we get approximately 20% uplift in traffic from people inviting other people into the groups. So the first thing we say after you join the group is, share this on Facebook, or specifically invite some of your Facebook friends. But at the moment we're going through a split test to see which of those is more effective, and as it's a random 50-50, we happen to get share on this case and rather than invite. So I won't go through that process, but I can hit this, and it's just a standard Facebook dialogue to post to my wall to tell everybody that I've just joined this group. We'll kill that. And then when I skip through, I get to get a quote or set a reminder, and if I hit get a quote, then I'm taken off to our, in this case, Acclerator, who's our provider for travel insurance. And then subsequent to that, you'll get a welcome email with a shareable link that you can send to people that brings them back into the group. And then subsequent to that, you'll get some sort of automated email that says, either you didn't buy, so tell us, set a reminder, or you haven't invited anybody, so why not invite somebody? So there's a sort of ongoing process of trying to encourage people to either convert or to invite people into the groups. So I guess what I should say, this is kind of where the interaction stops, if you like. Kind of up to this point, we feel we're kind of in control of the customer and we know what they're doing, and we have good interaction with them on the Facebook posts. When we hand them over to the insurer, then that disappears. And this is the kind of part of the process that we would really love to, as I've been talking to Paul about, so we'd really love to improve, where we're working with the insurer to get that information to come back in. We really like to see you go through the quote and buy process with the insurer, and then maybe at the end of that process there's get an extra 5% discount for inviting 5 of your friends into the group, and we'll see if we can convert them into customers, or the group basically bringing people back into the group so we can then continue to interact with them and keep track of that relationship with them. So I think, there you go.
Does anyone have a quick question for Guy?
Demographic younger?
Our demographic is more to do with the fact that we've been focusing on pet insurance than the fact that we're on Facebook, I think. So it's generally, a bit of a generalisation, but sort of 30 plus and female would be the predominant demographic. But I think that's as much to do with the fact that we're focusing on pet insurance than. It's certainly not true in travel, for example, whether it's an older demographic, because that's where it's harder to get travel insurance. So.
If I can chip in quickly, we haven't mentioned the young drivers group that we have either. There's a lot of traction with that particular group. So, as Guy says, it's sort of a product of the groups we focused on rather than the customer base that we can access.
We've plenty of time to speak to Guy in the 2 scenarios we've got coming up. That's brilliant. Guy, thank you very much.
Pleasure.
Now we have Ralph Hazel from
Microexchange.
That Insure My Friend.
Yeah.
But Ralph, you also won the Aviva Hackathon, didn't you, with Insure My Friend?
Yeah, that was Paul persuaded me to go on the hackathon, and it was a very good decision. And I worked with some very talented people so that we were able to really further the concept. I'd been working on the concept for a while, but properly for 6 months with a couple of insurers. And so that weekend enabled me to really take it a step further, and being the winner, amazingly sort of has given it some momentum.
That's brilliant, absolutely brilliant. Ralph Hazel.
Thanks, Eddie. So just to give you a little bit of background on me, I started my working career at Lloyd's of London as a broker, hence my fascination with syndicates. And then I spent 3 years there, and then I spent 10 years in the financial markets as a market maker for new exchange-traded products. And really, my conclusion was that the internet was going to enable person-to-person marketplaces where consumers could interact directly with consumers. And so I started micro-exchanges in 2007 to focus on building retail-facing financial exchanges. So since then, we've built 6 different platforms, 4 for other clients and 2 which were in-house. The first one was Money Swap, which is my concept, which was basically I've got some euros, you've got some pounds, we agree a rate and we swap. And the Money Swap as a platform provides a sort of clearing mechanism. I think it's a great idea. It was a bit ahead of its day, and in 2007-8 it was difficult to get funding, but some Asian investors, Hong Kong investors, took the business over, and it's actually listed on AIM. But since then, some better products such as TransferWise, I think, have really taken the product to the next level. The Real Asset Company is a gold investment platform that makes it really easy to own gold. That's another one we run. Pelican Exchange is a disruptive fund management business where you can follow other people. It's sort of social trading. Asset Match is a bit like Second Market in the US for unlisted shares. LendingWell is a P2P lending platform. So just to give you that overview, my background is really understanding how the P2P finance space has really developed. And I really think now that insurance is actually, I think it's more exciting than finance, and there are a few reasons for that. I think that the counterparty risk that's relevant in P2P finance is far more in people's mind. When I lend £10,000 to someone on a platform, or I change £10,000 to euros on a platform, the counterparty risk is much more upfront. There is obviously counterparty risk in, will the claim be paid, but it's less prevalent, it's at the back, which makes me think that P2P insurance could take off more quickly than P2P finance. It's actually taken a bit of time to get P2P finance going. Now, I think across other business models, Airbnb is really the best example of where the collaborative economy has worked, and that's now a $10 billion business worth more than Hyatt. So insurance, what we're going to try and do, and Insure My Friend is a concept that we're building up the business plan, and we're hoping to work. We're talking to various people to develop it, but what we've been doing is putting together a user experience of how it will work. And at the core of it, it's about people forming networks with people they know and trust, and then an element of the premium is put aside, and that is for the self-insurance pot. And then the insurer is still there underwriting the risk, and they still have a policy. Now, we think that that's a good idea because the behaviour change that will come on the back of it will hopefully mean that there'll be less fraudulent claims. And then the network effect, as we've seen, bought by many, where people actually want to invite their friends into a network. So the product we want to start with is mobile phones, just because we think it's a good small product to get started with. There were 12 million policies last year in the UK. When the great thing about mobile phones in terms of insurance is that because we just ask them for their mobile phone number, we can verify that. Then we ask them to take a selfie, and with the selfie, we get all the data on the phone, so we know what brand, make, and model it is. And then we also have ID, so that that's all you need to do, and they're signed up. And then that's a mugshot. So then obviously what we would try and do is give lots of data and information on the network, who's in the network, who you're signing, who you've invited in, invite more people in, the size of the network, claims history, all these sorts of things. So how can this change insurance? Well, obviously the risk sharing element I think is key, and that will promote behaviour change, which hopefully with the network effect taking hold will decrease the marketing costs. And with that, you obviously have access to more interesting data on the individuals, and we're able to engage with customers in a way that I think it's quite difficult for insurers to do, where you can actually bring them into the conversation and share information. And then obviously offering a more personalised service. Now, and I just think that we're at a tipping point with technical innovation and acceptability, that now is the right time for these sort of products. And I've talked about the counterparty risk as to why I think insurance is actually more interesting than finance. And so now that we're seeing all these great innovation labs, such as the Aviva one, that are obviously encouraging this innovation to come through, which that's really ultimately why I think it is now that this could work. But ultimately it's the innovation in technology that's driving connectivity that will bring disintermediation and more efficiency into the insurance sector. So that's it. Thank you.
Brilliant. One or two questions for Ralph before we move on?
Have you thought yet about what constitutes that friends and family network? How?
The simple answer is no, but I think the starting point is that there's got to be a core to a network where everyone knows each other. I think if you only know one person in a network and then the network is 30 or 40 strong, So there will be rules that we would put in place, and there will be a certain amount of trial and error. Maybe you can't have someone, you can have secondary connections, but maybe not third connections. So there are rules that we need to think about, and the live environment will hopefully give us feedback on that.
Brilliant. Okay, Ralph, thank you very much. Thank you. What we'll do now is we'll break out into groups. I have a scenario for you. We have 2 one-hour sessions now, so I can invite you to take your tables now. I'll come around and shuffle you a little, just to make sure we've got a good mix, or shuffle yourself, please. Quick session now, just closing. We're going to do some reflection on what we've learned, and then I'll do a closing session. So does anyone want to give us some of their learning and reflection from scenario number 1?
So one of the things I found really interesting with this particular scenario is the potential tension between price versus cover quality. So in this particular scenario, would we see customers going for the cheapest possible offering, potentially at the cost of getting a really good quality product? Or would they understand their needs and the nuances of their needs sufficiently to be able to buy a really good product that does meet all the different types of risk they face?
Okay, would anyone want to pick that up?
What did you conclude from that?
That it could go both ways, and that for some customers, I think they'll fall into different camps. You'll have some customers, perhaps those that shop on aggregators today, that will perhaps focus on price, and that perhaps other customers, if they really, to the heart of the scenario, engage with their protection needs, maybe they will actually buy more cover than they might today, but kind of difficult to guess.
Do you think that the way that they present the information then, do you think that would influence the choice?
Yeah, I think it would, and one of the other ideas we had was whether you'd see a move away from niche products or siloed products to more like a lifestyle product, where you're able to say as a customer, these are all the different risks I face, rather than potentially sell me one product for this one risk. Can you help me with a product that covers all the different risks? I think it largely goes down to whether customers will truly engage with it and truly want to protect the different risks, or whether in today's world it'll still be fairly mercantile and I don't want to engage with it, I don't really want to think about it, it's not interesting, just tell me what the price is going to be. I'd like to think it's the former, my worry would be that it's the latter.
I was in the same group, so we're talking. The other thing that led us to was, for most consumers, the lack of interest in this space probably meant you went to a degree of automation where they sat behind the scenes, and a wonder whether this led to almost spot hunting for the best rate to cover you on a day basis, which we weren't sure whether we liked that or not.
Do we have any other reflections on scenario number 1?
So I think if you follow this scenario to its logical conclusion, where platforms do pop up and disappear, you end up with kind of platforms where you're trading risk, so that the market would become risk orientated rather than product orientated, and the insurers would end up effectively trying to arbitrage between their underwriting model and the price of a risk on any given day, and snapping up the risks where they felt they could make profit based on their underwriting models. I'm not quite sure what that implication that has for the... I think it completely changes the business model of the insurer to being much more focused around finding risk at the right price and getting as much on the books at that price as they possibly could.
Well, what do you think? What do you think the impact would be?
I think it would be, wouldn't there? But I think it depends how big they are. I think that's the challenge, isn't it? So if you've got very small syndicates, then is it really worth, quoting for those or creating a specialised variation of the product? If the bigger they are, then the easier and more likely you are to do so. So it's kind of finding that threshold that it becomes interesting for insurers to kind of start thinking about those pools of or syndicates of risk.
Any other comments?
I think it's difficult to see the scenario where you're not going to have a regulated... You're always going to need the capacity providers and the regulated insurance vehicles at the top, whereby you have syndicates that are set up. To understand the regulatory problems there, and the capital problems are massive. So, it's a big step to see, a new Lloyd's of London, a digital Lloyd's of London starting. That's a big step, So that's what we concluded.
What about the crowd side of things? This is guys bought by many. Any reflections on this model? Here we go, Peter.
Yeah, one of the conclusions that I came to was the fact that Facebook might be the initial platform in which these companies operate at the moment, but it might be that 5-6 years down the line, the likes of Amazon and Mumsnet will be the platforms from which these companies can actually thrive, because they have more analytics based on the individual. So for example, if you look at Amazon, you can actually determine someone's lifestyle according to the purchases they make, and that would probably help these companies to determine what level of risk they assign to an individual.
So just to expand on that point a little, Peter, I think it will be interesting to see which of those platforms are going to be the most successful if this scenario pans out, because it will probably, my hypothesis is it will probably be those where people feel the most affinity. So the question is kind of how will people group together? Because they could group together around their job, they could group together around their hobby, they could group together around their geographic area, and there will be different organisations that you describe in a position to monetize basically coverage of a hobby or a geographic area or whatever it might be. So I think depending on exactly the mechanics of the grouping, a different organisation will win and different organisations will become more influential.
There's a couple of things that we were discussing around the groups, and at the moment it seems as if there's a scenario of get a group together, give them some upfront benefit to insure as a group. But the real value only comes when you start pushing the data back to the group, so the group can actually modify its behaviour in order to make the group work better. Because there needs to be that two-way communication in order to make it a long-term viable relationship for both the group and the insurer. And I think also if you can do that, there's also the scenario of being able to push some of the services into the group. So if the group, for whatever reason, want a different level of service to the norm, then there's nothing to stop the group providing that level of service within their own capacity and sourcing that contract themselves, and not getting the insurer to fulfill every single part of the chain.
So whilst there's lots of insurers in the room, I thought I'd say a few words about how we'd like to see this develop. So currently, if you have any sort of slightly unusual need for insurance, you're buying a standard product, and from the insurer's perspective, they don't see enough volume of this slightly unusual need to create a variation on the product. So, it's entirely understandable economics. why would I bother to rate specific levels of a particular disease for people going on travel insurance when it's only a 30 quid premium for the travel insurance, you know? So what we would like to see is, as we get groups to be larger, and if this model expands, is that it becomes viable for the products to be tailored more to the groups, because you're seeing a larger volume in any particular place. So really good examples of that would be, we'd like products for, say, homes in flood areas where you just exclude the flood cover. And so you can still get theft and fire, but you're just not covered for flood. But that's very difficult to achieve at the moment. And then, I had a really good example. I've forgotten it now, which is annoying. But we'd like, and same with travel, actually, where you could exclude the condition that's pushing your premium through the roof, but your baggage is still covered and you can still get repatriated. You just can't get cancer care in the States. You know, and that's how we would like to see the fact that you're bringing people into groups affect the policy production in the first place, as it were, rather than as we're in the position we're in at the moment, where we're just offering a discount or, you know, maybe some tiny tweak to the product. But we think there's scope for the fact that we're bringing volume to influence how the product's produced and then make it more fit for purpose.
Does any insurer have a comment on that? Does anyone want to respond? Because you were saying there's clearly an issue. I don't know whether...
So the other one that we've been talking about quite a lot is for for drivers specifically, but monthly policies in almost any space would be really nice to have, so that as the volume of the group increases or the claims experience of the group becomes revealed, then the premium could change on a monthly basis. So at the moment that's a real pain in the neck, because you have to give cash back, or you know, or it's a 12-month policy and you're 8 months through, so how much money do you give back? And it's just an administrative nightmare. But if the policies were on a rolling monthly basis and the premium was collected on a monthly basis, that would give us much more flexibility to reflect the behaviour of the group and the size of the group in the policy, in the premium.
Any final comments on scenario number 2? Right, well in that case, big thank you to Aviva, to Iris and to Barclays for hosting. We're going to pack up now, and thank you very much for coming along and supporting us. We're done. Thank you.